Best ever listeners, welcome to the best ever CRE podcast. I am your host, Joe Cornwell, and today I'm joined by David Hrizak. He is the CEO of Streamline Capital Group. They are doing a lot of different things in real estate, including some new development and medical and Class B office value add. They've been in the business over 29 years. First time on the show. David, welcome. How are you today?
I'm doing great, Joe. Thank you very much for having me. It's great to be here today.
Well, I appreciate you joining us. And since it's your first time, tell us a little bit more about you. Where are you from? And then how'd you get into real estate?
Absolutely. Thank you. So I am originally from the south side of Chicago, born and raised there. I was raised primarily by my grandmother. My mother was always out working long hours in downtown Chicago. No father figure in my life. So my grandmother was the one that kind of took care of me as a young child growing up. And everything I am today is because of what she instilled in me: loyalty, work ethic, determination. It was those things that this 4'9" woman taught me on the streets of Southside Chicago. So I'm very proud of that upbringing, and that's who I am today. So I started in real estate 29 years ago in the Chicagoland area as a commercial broker. After a few years of doing brokerage for multi-tenant investment properties, I moved on to development and investing for my own portfolio. So we started with some flips of single-family residences, went into some new construction on single-family, then went into apartment buildings, retail, and the success story built from there. And that success went on until 2021, when I had a near-death experience, was thrown off a horse in Puerto Vallarta, Mexico, spent 3 days in a Mexican hospital with a collapsed lung. And I told myself, if I can get home safe, I'm going to retire. And I had a successful 25-year career, 26-year career at that point. And my wife had just retired from teaching here in Arizona. And I did. I was deathly afraid getting on that plane. The doctor advised me not to do it, but I made it home. My wife held my hand the whole time, and I retired. And for the first 10 months of 2022, we traveled. We enjoyed each other's company. We traveled the world, including 3 great weeks in Europe. But by October of 2022, as I was nearing my 50th birthday, I had a void within me. I was missing something. And that's when my current partner came to me and said, Dave, I'm looking for a new opportunity. And he's an attorney. Scott Roney has been an attorney for 30 years in the Fortune 500 world. So I said, Scott, I really want to reinvigorate what I had fun doing the most, which was helping people invest in real estate. We had many syndications where we brought passive investors in. They didn't know too much about real estate. Some did, some didn't. But we educated them. We brought them along on the journey. So at my 50th birthday, we formed Streamline Capital Group with the goal of assisting people build long-term wealth through passive real estate. And it has morphed into the Streamline Companies, which is a conglomerate of 3 entities. You mentioned Streamline Capital Group. That is our real estate investing arm, where we're raising the capital to buy properties. We currently have an open 506c fund raising $15 million. I own Streamline Development, which is a general contracting firm. For 23 years, we have built everything that we owned, whether it's out of the ground or capital improvements or tenant improvements. So we still have the ability to do that through Streamline Development. And then any property we own is under our management arm of Streamline Asset Management. So the vertical integration of those 3 entities allows me to give my investors a streamlined process, a better return because things are kept in-house and we don't have to worry about any third party not acting in our best behalf.
Yeah, I mean, there's a lot to unpack there. I'm glad to hear you obviously recovered from your injury there. That I can see how that would be a kind of paradigm shift in the way you think and the way you view life and your career. There's a lot of things I can kind of pull from your story that I relate to. I left my kind of first career. I was in law enforcement for 10 years, and kind of semi-retired because I had enough cash flow from the real estate portfolio I'd built to kind of pay the bills. I left my day job, and similar to how you mentioned, it was this first 6 months or so, I really felt a loss of purpose. Obviously I'm younger, I'm in my 30s, but it was like, what am I supposed to do now? This is who I was for 10 years. Now I'm not working full time. Obviously I was, kind of managing my portfolio, but yeah, I think a lot of people look at retirement as this pipe dream, and they spend a lot of their life, kind of thinking about this moment and what it's going to be like. And it's going to be this big, grand, change or something like that. And more often than not, if you have a passion or something that provides fulfillment, you reach retirement and it kind of leads to more questions than answers, in my opinion. And now, if you're miserable and you hate your job and you're punching a clock at a factory, making bumpers or something, I could see how doing that for 25 or 30 years and reaching retirement is obviously going to have a different meaning to you than if you are passionate about what you're doing. But
I've come to the realization that entrepreneurs don't retire. They just either move on to something else, change their philosophy, pivot into something else. But entrepreneurs like you and I, we just need to keep going.
Yeah, absolutely. Especially, if you're doing something that does bring fulfillment. And, you mentioned a couple things that you enjoyed in your obviously now long real estate career. Another thing I wanted to touch on, I really enjoy when I get to talk to people who have been through, it sounds like you started investing kind of mid 90s and you got in the real estate business in the mid 90s. Is that about right? Okay.
Exactly.
So you've obviously seen now several market cycles. Tell me a little bit about that. Just kind of broad thoughts now having gone through, again, several market cycles. What are your general thoughts on real estate markets in general?
Having the 29 years of experience, I think I've seen almost everything now. But when it happens to you for the first time or the second time, you get scared. And if you're not quick to react and quick to pivot and quick to understand how you can change this for the better, you're going to be sunk. And yes, I have had to pivot. The Great Recession of 2008, 2009, I was in a $4 million townhome development in the Chicagoland market. The market was crashing. My business partner died in early January 2009. And I was left holding the bag. And fortunately, I had a great relationship with a community lender. The community bank, once the CEO of the company owned the majority of the bank. And he called me up and said, Dave, the government's all over me. We're a smaller bank. TARP was a big thing back then. Federal regulators were coming into the bank on a weekly, monthly basis, and your loan is one of the things they're looking at. I said, well, what are we going to do? And he said, let's work together on this. And we pivoted. Instead of building a development to sell, we built it, we finished it off, and we rented it. And we rented the 16 units in the development for about 4 to 5 years until the market turned around and I was able to sell it. And if it wasn't for having a lender that I can communicate with directly, one that was willing to work with their borrower, any other bank would have taken the property, sold it off for pennies on the dollar, and taken government money to bail them out. But he was an entrepreneur just like I am, and he was looking for a way to A, save his bank, and B, help me get through this as well. And I'm grateful for that.
Yeah, and it's such a great parallel to the contrast we're seeing in today's market, right? Where a couple of years ago, you started hearing all these kind of whispers of, oh, there's another big crash happening, especially in commercial real estate. All these people bought on bridge debt, and there's going to be this huge wash of foreclosures, and everyone's going to lose their properties, and we're going to be able to buy them for 50% of the value or whatever, right? Kind of like what happened in 2008 and 9. And I think a lot of banks learned from the mistakes they made in 08, 09. It sounds like your bank was one of the few that actually looked for ways to find a path forward out of deals that went sideways when the market shifted. And it seems like a lot of banks today are doing the same thing. I mean, everyone keeps saying, oh, well, there's going to be this huge wash of inventory. And we are starting to see some of that slowly trickle out, but it's been a 2-3 year window where these deals have started to hit the market. And yeah, of course, there's a lot of people out there losing money. Maybe they overpaid, they had bad debt, insurance spiked, all the taxes spiked, all these expenses happened that weren't necessarily expected. But banks weren't quick to go and just foreclose on thousands of these properties. And then, as you mentioned, take them to market where they're going to get pennies on the dollar. They realize that if they can keep that operator in place and keep them at least somewhat functional above water, let the operator sweat out the market, not the bank. And that's a big difference than what we saw in '08.
Yeah, there was so much talk over the past 12 to 18 months about what is coming down the pipeline with mortgages maturing across the country. And I've read, just like you, many times, banks are restructuring those loans, extending those loans, and not foreclosing on them. They're working with borrowers, which is the way it should be. It's not the borrower's fault that we had such high inflation and such rapid increase in interest rates. They're most likely good properties. However, if it comes due on their 5-year loan and the interest rates have doubled or tripled in some cases, what are you going to do? You have to work with it. It doesn't make sense to foreclose on that property.
Right. I mean, and even in those cases, a lot of the LPs are the ones, that are getting wiped out, right? If they raise 25-30% of the equity and there's a stark fall off in value, I mean, that's the 20-30% that's getting absorbed, right? Is the LP money.
Yeah.
The banks aren't the ones taking the hit.
And that's why we're bullish on buying today because of the higher interest rates. I would rather buy at higher interest rates. If you can make a deal pencil out in today's environment, it's only going to be better if and when those interest rates do come down.
Absolutely. Okay, let's talk a little bit about your latest endeavors. I know you said you're doing some medical office value add. You were doing some, what was the other one you're into right now?
Class B.
Class B office, yes. Tell me a little bit about that. Why, where are you investing, and what do those deals look like?
So we're located in the Phoenix market, and we're investing in medical office, number one, because it's economic resistant. Whether times are good, times are bad, people need a doctor. Arizona's population is growing on a daily basis, and it's growing steadily because of all the new corporations moving to Arizona because of the business-friendly environment, bringing more residents, which require more services. Mayo Clinic just is going into $1 billion expansion here in Phoenix. We have medical schools from around the country coming to Phoenix to open. And because these businesses are moving to Arizona, they don't have to worry about natural disasters shutting down their businesses like they do if they were in California or Florida or in the Midwest with potential hurricanes. Arizona, knock on wood, is a stable environment. From the natural disaster point of view, it's a great place to do business with the government, from the government point of view. And as the population grows, we feel the medical is going to continue to grow as well. On the flip side, we like Class B, which is the home of smaller businesses. So everyone reads about the office demise and the return to office. Those are really your larger corporations in your high rises or bigger buildings in Chicago, New York, San Francisco that had to send people home through the pandemic. Well, small businesses of America, which comprise 99% of all businesses in America, didn't have the luxury of sending people home. Cash flow is the most important thing to a small business. And if they can't keep their business running, they're going to shut down quickly. So the small businesses typically are your insurance company, wealth manager, attorneys, architects, marketing companies that don't want to be remote. So when we go in and buy a Class B building, we have a rent roll where no tenant typically occupies more than 10 to 15% of that building. So we have diversification in that rent roll if something does happen. But when we buy these value add buildings, we go in there and make them into something better than they currently are. We typically budget capital improvements starting day one into our buy analysis. And that could be capital improvements to the common areas, to the exterior of the building, to a new parking lot, to building out spec suites if there are vacant units within the building. So when we bring the quality of that building up, the current tenants appreciate it, and it helps us attract new tenants to the property as well.
Hmm. Okay, tell me a little bit more about that. Like what? Well, let's start with this. Define Class B. What are you defining as Class B? And I guess maybe give us a little bit of a contrast as to what would be C or A in contrast for your definition.
Sure. So your Class B are typically 3 stories and less. Doesn't necessarily have a grand entrance like a Class A building does. Think about walking into a building in downtown New York or Chicago.
Okay, so no big, 50-foot high, 30-foot high ceiling with escalators and foyers and elevators and all that. Okay,
that's wasted space.
Okay.
That's great square footage that can be capitalized upon. So these buildings are anywhere from, say, 70,000 feet and below, and 3 to 4 stories or below. Now, Class A are your high rises, 5 stories and above, all the way up to the what I still call the Sears Tower, being from Chicago. Those are Class A buildings. And then Class C is really your exterior load. I call them California balcony type properties as well. What's interesting in today's market, you hear a lot about office conversions and how vacant offices can be converted to apartments. Mm-hmm. Well, when we buy a property, we buy those that may not be able to be converted. Not a lot of buildings can, just because of the infrastructure layout. So as people convert buildings to multifamily, or buildings are demolished, we've had a rash of that in Arizona. They're being demolished for more industrial. They're taking away the Class B inventory, which if you decrease supply, guess what? Prices go up. So prices in Class B rents have actually climbed over the past couple of years because the quality, the quantity of good quality Class B has been decreasing because of that.
Okay, so I heard you, sounds like your prototypical tenant is going to be typically like some sort of almost white collar professional business service, something along those lines. Are you doing any of the like private office suites? Like, maybe there's a remote worker who wants to have their own private office suite. Are you doing build outs for people like that, or are all of these businesses and people who want to work out of this office every day?
We are not. So the concept of the shared office, WeWork, Regis, those are true businesses that are running. And we've spoken to them, but we don't necessarily like the business model that they propose to take that space over. They don't truly sign a lease. They go into a partnership agreement where we're participating in the profits that they're earning within that location. Our philosophy is to have a true lease in place. It helps get a better handle on your cap rate for the building and your cash flow for the building so that we can truly understand our value each day.
What's your smallest office and largest?
My smallest is 600 square feet. My largest is 4,800 square feet.
Okay. Got it. Makes sense. And in your market, have you seen a lot of those other, as you mentioned, other Class Bs that are being converted to housing? Is that what's helping drive demand, or is that not happening in your market?
We have seen it here in our market. We've seen both the conversion to multifamily and the demolition into different asset class.
And what vintage are most of these Class B buildings?
The ones that are being converted are probably 1990 era. The ones that are being demolished are probably pre-1980.
Okay. And the things you're buying are similar 90s or so?
Yeah. Yep.
Okay. Got it. Yeah, I mean, and my understanding is limited on the Southwest markets in general, but my limited understanding is a lot of that inventory is newer. Like, so 90s would be at least newer compared to, the East Coast where anything built after 1950 is relatively new in a lot of our neighborhoods.
I understand completely. Growing up in Chicago, the first house my wife and I owned was built in 1890. So I understand the vintage of the Midwest and East Coast.
Yeah. Definitely different. Yeah, because a lot of Phoenix was developed in the last 30 years or so.
Correct.
Okay, so tell me a little bit more about the medical office. Like, why don't we do this actually? Let's do our good deal, bad deal segment. So let's start with the good deal, and maybe you have one medical office you can break down for us, the numbers, what the asset is, and how it played out, or how is it playing out if it's in process.
Sure. Well, one of our buildings we purchased about a year and a half ago, and it was 90% occupied at the time. The owner at the time had owned it for about 5 years. It was not on the market. I had just contacted him directly because I liked the building, asked him if he wanted to sell. He was interested in doing so. As I was going through the numbers, I came up with the valuation higher than the number he was willing to sell for. So I knew from day one we were in a good position. When I started analyzing all the leases, they were gross leases where the tenants are just paying a flat rate and not participating in any CAM or triple net cost. We have a triple net philosophy. So when we get into a building, any new suites that are available, we put onto a triple net lease where the tenants pay their portion of all expenses. And then as leases come due, we roll them into net leases as well. So when we do our analysis, we look at what is the base rent in the marketplace and what is the building and what's the delta between those two. So we buy based on the delta of what we can raise those rents to by providing a better quality building than it currently is. So the building that we in question bought a year and a half ago, 90% occupied. I have now put it into 100% occupancy status on triple net leases throughout, I would say 90% of the building. There's 2 tenants that have some longer term leases coming due next year that we'll put onto triple net at that point. And we do lose tenants. Don't get me wrong. When tenants see a lease rate higher than they had been paying, they think, oh my goodness, I need to go somewhere else cheaper. Well, when we improve the office suites and make them into spec suites, we're able to charge more and still stay below our good competition. So we're able to fill our suites in this building pretty quickly. We've been fortunate with that. And once we touch those next 2 leases and everything's on triple net, we will have taken the value of the building from $3 million close to $5 million in the next year, which would be probably at that point would be a 30-month time period.
Now, in the instances in with these small office or even medical office where it is multi-tenant, are all of the mechanicals separated per unit? Like, how does that work with the CAM, or are they just paying a percentage of their use?
It depends on the building. It depends how the infrastructure was set up. I own one building where every tenant pays their own utilities, and then their CAM charges just cover taxes, insurance, and common area maintenance. I have some buildings where there's one electric meter through the whole building, and that gets billed back through on a percentage basis through the CAM charges.
Got it. Okay. And in that instance, let's say a furnace went out and it was $10,000, which you may not go through a lot of furnaces and furnaces in Phoenix, but we'll use that example anyway. If that was the case, are you billing them, prorated per use, per square footage, percentage of use, or is it, that's something you guys just cover as the landlord, and then you're only billing them for actual utility costs?
So in our underwriting, when we look at a building, we immediately get boots on the ground and understand the age of all the mechanicals. And if there's a need to replace mechanicals, we're going to go in there day one and replace as many as feasible so that we don't have to worry about that. According to our lease, if there is a unit that needs to be replaced, that's a capital improvement. That's the landlord's responsibility. Okay. If it's just a repair, according to the lease, that's the tenant's responsibility.
Okay. Makes sense. Okay, let's talk a little bit about this development deal that you're working on.
Yeah, so I'm fortunate enough through Streamline Development, my general contracting business, to be involved in the development of the Nox, N-O-X. It is Italian goddess of the night in Italian mythology. And this development, brand new out of the ground development, is a 70,000 square foot music venue that's going to be built in Mesa, Arizona. And I don't do a lot of third party development, but this particular client, I have built 200,000 square feet over 2 facilities for their current business here in Arizona. And we've developed a great relationship. And he has been an investor in all 3 of the deals that we have through Streamline Capital Group since it was formed just 2 years ago. So the Knox is going to be a one-of-a-kind music venue in the Southeast Valley of Arizona, in Mesa, Arizona specifically, where it's kind of an entertainment desert. If we want to go see a concert, we need to drive 30 minutes into Phoenix or 45 minutes into West Phoenix. This venue will hold between 1,000 and 2,000 people. Intimate crowd, second floor VIP balcony ring. The owner wants it to be one of the top 10 facilities of its size in the country. So we have spent 3 years now on the back end developing it, utilizing consultants in every facet, from acoustics to sound to lighting to structure. We are now 30 days away from submitting for a building permit here in Arizona. The city of Mesa loves the idea. They've been supportive throughout the process, and I can't wait to break ground in December, and it'll be an 18-month project to build. And after that, this facility is going to be one of a kind here in Arizona. And the owner wanted to do it as a legacy project. He wanted to leave something for the community. The community has been very supportive of his business here in Arizona, and he wants to give back to the community and leave this for the community that supported him.
Now, when you're looking at a project like this, and I obviously have done a lot of legwork on it for the past several years, what are the most overwhelming aspects when you're trying to put something like this together?
Wow. When we went into this project, I didn't know what I didn't know. I learned something new every day on this. I've built multifamily retail, industrial, office. Piece of cake. When you get into something this specialized, the sound, the acoustics, and the lighting have been the biggest thing. And the reason it's taken us 3 years to develop this is after we had our floor plan developed and our site plan developed, we found our sound consultant. And he took us on a tour of a facility that he had recently refurbished. And we loved the sound. It was crisp. It was clear from every seat throughout the auditorium. And we said, can you make our theater sound like that? And he said, no, your design sucks. And we were floored. We were probably a year into it at that point, a year and a half. We were floored. And he said, your design needs to be a different shape. It needs to be a different size, this, that, the other thing. We all walked out dejected that day. And the owner said, rip up the plans, start over, design it according to how the sound consultant thinks it can be one of the top 10 in the country. And we have. And we're super excited.
Yeah. That's, I even now that as I'm making development kind of my core focus and my core business here in Southwest Ohio, it is the amount of moving parts on just traditional real estate. We're doing some residential and office development right now, like a mixed use property. It's overwhelming the amount of moving parts that have to all be organized and try to fit, into this kind of neat package. And I can't even imagine all the extra angles, as you mentioned, when you're talking about the shapes of the buildings for acoustics and obviously sound systems and seating arrangements. And yeah, I mean, that's making my head spin even thinking about it.
Yeah, when you get into development and the project management of a development, you're not thinking about today. You're thinking about 2 weeks from now, a month from now, 4 months from now, how those components are going to flow into what's being done today so that it's a seamless transition into the next phase so that you're not stuck waiting. Yeah. So I wear a lot of hats. I juggle a lot of balls, but I love what I'm doing.
Yeah, and one thing I'll say to our best ever listeners is that coming from a construction background, that's kind of how I got into real estate, was through the construction angle. So similar to you, I did a lot of heavy value add, and now I'm kind of shifting into the ground up and development side. But for me, when we back to the original, topic of this conversation, when I look at getting fulfillment from real estate, because it's a grind, and obviously you know this better than anybody, having been in it almost 30 years. Every day there's challenges. Every day there's frustrations. Managing the people aspect, at least for me, is probably one of the most frustrating parts. It's not the brick and mortar. It's the people in it and outside of it. But when you talk about actual fulfillment from this business, it's seeing something that was, and then what you've made it, and obviously through all of your contractors and employees and team. And of course, it's not just us doing it ourselves, but to me, that's where I get the fulfillment. That's what keeps me coming back, and, almost like in a masochistic kind of way, because it's always painful and frustrating. And I don't think anybody is, in real estate long enough, it doesn't constantly have to ask themselves, why am I doing this? Why am I choosing to do this today?
Yep.
But yeah, that fulfillment is what, keeps you coming back.
And everything you just mentioned is so overwhelming to the majority of people out there. Yeah. And that's why we have developed on our investment side a passive investor portfolio. People would love to own real estate, but they don't know how to deal with tenants and toilets and trash. Mm-hmm. We take them through that process. And what's unique about what we do is we host investor days. We call it Kick the Bricks. We bring them out to the properties that they own so that they can see from day one where it is to 6 months or 9 months later what it is and how it's transitioned. And yes, it is a grind. It is a kick in the teeth many days, but that entrepreneurial spirit keeps me coming back and keeps you coming back every day to keep doing it. And a lot of people can't do it. They can't handle that type of pressure or even begin to fathom how to deal with it. When someone like yourself or me understands it, and an investor can tap into that and learn if they want to learn, or just come along for the ride and be with us along the way, that's where they're going to have fun and make passive money, passive returns, and be better off for it.
I couldn't agree more. I've been in real estate now probably 9 years, and I used to look at LPs and be like, man, I don't really get that. It's like, you're making money. Why are you just giving it to somebody? Why aren't you out there going and trying to buy your own small deals if that's what you want to do, and try to have some semi-active or semi-passive role. But the further along I get, the more I realize that the happiest people in every real estate deal, assuming it goes well, is the bank and the LP, because they're not the ones having to deal with all the things you just mentioned. And, I think that just comes with experience and wisdom and maturity, is realizing that, just because we're the ones doing the day-to-day operations doesn't mean we're the smartest one in the deal. Let's put it that way.
I agree with you there. And because of the success I've had, and sounds like you've had as well, a lot of my investors are repeat investors. They follow me from deal to deal because they trust the process. They've seen me grind it out, and they've been successful along with me. Yeah.
All right. So before I let you go, you've been in this business now almost 30 years. You've, as I mentioned, seen several market cycles. When we look ahead, we're recording this about midway through 2025. As we look ahead, what are some of the things you're excited about in the coming economy and coming market? And what are some of the things that you are concerned about going forward?
Well, I'm super excited about the 100% bonus depreciation that was reintroduced in the big, beautiful bill that was passed last week. Yep. That is such a motivating factor for real estate owners. And a lot of people don't understand what that means. When you buy real estate, there are certain tax advantages that come along with it. And that bonus depreciation makes those tax advantages even better. Yeah. So, a great example. Last year, the bonus depreciation was down to 60%. And for anybody that gave me $100,000 last year, I was able to give them a $70,000 loss write-off. Wow. Now, they didn't lose money. That was just the tax advantages that are in place. Well, that $70,000 now is going to increase because we get back to 100%. You don't get that type of tax advantage when you buy stocks and bonds. And a lot of people don't understand what tax advantages can do for your return. If you don't have to pay taxes and you get to keep more money that you made, your returns are significantly higher. And when we advertise what our returns are, we don't even include that in our numbers. So if we're telling you we're targeting a 15 to 18% IRR pre-tax benefit, that's probably a 20% or better after the tax advantages. So I'm super excited about having the bonus depreciation back. Super excited about the potential of interest rates coming down later this year and into next year. There's been so much capital sitting on the sidelines that has not done anything. And I think as we see this tax bill come to fruition and we see interest rates potentially coming down, capital is going to free up again, and it's going to spur a lot more activity in the investment real estate side, whether it be through our value add or your ground up development as well.
Well, I couldn't agree more. I am definitely excited to have some of the benefits of the new tax bill. And obviously it's from a political standpoint, there's a lot of pros and cons and a lot of people fighting and arguing over the merits or demerits, I guess, of the bill. But from looking at strictly from the the taxes and the real estate aspect, certainly a win for investors.
Absolutely.
All right. Well, David, I really appreciate your time today. Any other final thoughts you want to give us before my last question?
Joe, if any of your investors would like to learn how to become a passive investor, I'm happy to meet with them. I answer all of my emails through any time of the day. djh@thestreamlinecompanies.com, or you can find me on LinkedIn at David J. Hrizak, Hrizak. I love to help people. That's what brought me back to this business. And I'm here to serve at this point in my career. Almost 30 years into it, I've made my money. Now it's time for me to help other people make money as well.
Well, that's great. And that was my next question. So thank you for giving us the best way to contact you. David, thank you so much. I learned a lot, and I'm sure our best ever listeners did as well.
Joe, thank you very much for your time. Great show. And I look forward to listening to more of your shows as they come out as well.
Thank you. Best ever listeners, thank you so much for tuning in. If you enjoyed today's episode, be sure to leave us a 5-star review and share this with someone who could value from it. Make sure you are following and subscribe to the podcast so you don't miss any. Thank you all for listening and have a best ever day.